Welcome to the PI World interview on Thursday, 24th of September 2020. I'm your host, Tamsin Freeman, and today I'm delighted to be joined by Richard Crowe, more commonly known as Cockney Rebel, who's with us following popular demand. Richard is a veteran of the private investor community, and today many of you will know him from Twitter or his private chat room, which he migrated from ADVFN. Richard, many thanks for joining us.
Pleasure. Nice to see you.
Can you tell us a little bit about your background and how you got into investing?
Yeah, I started probably buying shares back in 1982 it was. I'll tell you how my life started really. I grew up in Essex with a lot of people know was my brother Bob Crowe was the union leader. So the pair of us grew up together. He was the RMT union leader, and we grew up together in Essex. We were like chalk and cheese. Him and my dad were unions. Myself and my mum were we didn't get it. We didn't get unions. I was always sort of like business minded, even from a young kid. And growing up in Essex, I did like a lot of kids. We had small jobs to get your life through when you're 16, and that I worked in a supermarket. But one of the jobs I had was a newspaper round, and I used to deliver papers up to places in Chigwell. I was living in Hainault, which bordered onto Chigwell through the forests, and there'd be loads of these big houses up there. And as a kid, we come from poor council estate. I'd go up there, deliver papers, and Saturday nights, all the guys used to chat to me about the football results when I handed them the paper and they paid me. On a Friday, if they paid me, the guys all wanted to know about their share prices. So they're looking at the back of the evening news. And I used to get chatting to the guys and say, what's this about shares? And they said to me, when you get older and you've got a few bob, stick it in shares. And I I like these big houses. This is how they've done it. It's always stuck in my mind. So I left school. And when I left school, I sort of always wanted to do my own job, have my own business of some sort. And I went out and I became a milkman to start with, try and raise a bit of money and earn some cash to stick away and then start my own business. I didn't know what I was going to do, but it was build a pot of cash. I did that for a couple of years, and then I had a motorbike accident at 19, which put me in Stoke Mandeville Hospital, where I met the nurse. I ended up in a wheelchair, and I was paraplegic, and I met a nurse there. We got married, and we moved to a local village. We've been married 43 years now. So the village we moved into was quite close to where we were. We had a little small bungalow, and I sort of thought, well, I've got to get a job. I was always used to working, and I decided, well, I'll keep tropical. I used to keep tropical fish, so I built a tropical fish house, bred tropical fish, started selling them around the country. Then I was asked to write a couple of books and edit a magazine at the British Cichlid Association. I learned a bit of design from that, and from that I learned how to start my own design and print business. I'd always been quite good at art. Did that up until the turn of the century, and then that was when we had the tech boom in 2000, just coming up into 2000. And I was making a few bob then, so I'd already started buying shares back in 1982. And we had the biggest, I had the biggest lesson of my life, which was in 1987 when we had the Black Monday crash. So I had an insurance guy saying to me, buy unit trusts, buy investment trusts, buy this, buy that. And I was buying them, and, the market was going up fantastic. I was coming down in the morning and thinking, Pacific's up 7%, Japan's up this, our unit trusts are doing fantastic. Then one night I was watching news at 10 and it said the Dow Jones has fallen 100 points and fears of a crash and all this. And I said to Karen, tomorrow morning we'll sell just before, all the, in case there's any problem. Well, I woke up next morning, no one was answering their phones. The brokers weren't answering their phones. The market went down 12.5% in one day. Next day it was down another 12.5%. And I just looked at that and I said, we can't carry on like that. We've got to get these things sold. I don't know how low this is going to go. So we phoned my broker. He managed to sell them for me right at the bottom of the market. And we got out right at the bottom, and I watched the market bounce 10% the following day. And I thought, this probably isn't for me. All I'd done was punt penny shares and stuff in that time. I always followed Jim Slater in his book, Zulu Principle. And I'd been reading that, and I'd started to try and buy shares on that basis. But then tech came along, and you just couldn't fight the trend. You just had to be on these tech stocks, and they just went fantastic. And I bought one or two, and one particular one was Affinity Internet. And I remember we woke up one morning and they went up 50% before I'd even got out of bed, which was sort of like fantastic. I said to Karen, God, you realise how much money I've made before we even got out of bed this morning? And so we made quite a bit of money during the tech boom. And then when the tech boom ended, I noticed that Affinity Internet were always putting out bits of news, and the share price would go up, and they put a bit of news out that they were doing something with Vodafone, and that was what really boosted the price that morning. And in about March, they put out some news which was to do with PowerGen, and they'd signed up PowerGen, and the share price didn't do anything. It just sort of went up and come down back to where it was. And I said, "Okay, that's strange, you know." And I watched a few other shares, and they did that as well. And I said to her, "I'm not completely convinced this market's going up any further." And then the whole market did start to slide back. And I think I sold out in about June, and we got out quite well at that point. And because having been scared by the 87 crash, I was particularly sort of careful not to do it again. And I probably didn't invest as hard as I could have done in the tech boom because I was a bit scared as well. I probably would have made more money doing if I'd been a bit braver. But anyway, we got out quite well out of that. And from that point on, I said to, I sort of thought, I've got to start investing properly now. I can't muck about with these tech stocks anymore. They're not real. And from that point on, I sort of followed the Zulu principle of Jim Slater's. And I've done that. I've done some of that ever since. I've followed stocks that do, if I see something that really looks a bargain and it's high growth, the growth is a lot higher than the PE, then I've sort of tried to track stocks like that. But in later years, I've got more into recovery plays, because over the time, the stocks that I've made real good money on have been recovery stocks. Like Hornby was probably the first one I had, which was a recovery stock. And I bought that down at £1.47, and within a couple of years, it was up at £10. And you can, the good thing is now you've got the internet, you can go around and you can actually find information. I used to go onto the model railway sites and listen to what these guys were saying, and they'd all be saying, the new Flying Scotsman's fantastic, or this is, and they're all geeky, so geeky, and you ask them a question, they'll talk to you for hours about what's happening. Shops are waiting 3 weeks for this one to come through. I just think, well, they must be busy. And that's the great thing about the sort of stocks I like, are stocks I understand. I don't really go a bundle on tech stocks and internet stocks and pharmaceuticals and oil companies. I can't get to understand them. But retailers, you can understand that business. You can go in there and you can say to yourself, there's this company doing very well. At Kingfisher at the moment, they've had some fantastic results just come out. Share prices go flying. And you can actually go in there and go down to Screwfix and have a look and see what's going on when you go in there. And there's all vans parked outside there all the time. I'm always shopping there at Screwfix. It's a man thing. There's so many bits and pieces you can buy in there and just take home and look at. Even if you don't use them, you've got it. You're a man. And B&Q as well. I go to B&Q, and I know I don't really like the store. There's something about it, and it's got room for improvement. B&Q, that's the bit that's got the room for improvement. If they could sort of get that more towards a Screwfix model and stuff there, I think Kingfisher is probably an interesting one that's popped up. But those type of things where you can actually get in there and have a look at the company, I think I'm trying to think ones in the past where I've done well on. Like Thomas Cook was another one that was really good, because you could actually see the holidays that were being booked, and you could see the recovery there, and you could ask people, did they go with Thomas Cook? Everyone was flying with Thomas Cook, so that was a fabulous one as well. And Greg's was, I am Greg's man. If it's pies, I'm your man. And I knew Greg's were doing well. I could read about them in there. You could go in their stores and see people. You could see what the product was like. So anything like that, a recovery play, and it's touchy-feely for Joe Public. I love stocks like that. But I also trade as well. So I might see something in the morning. Someone puts out a trading statement. You think, that's got to go up, and I might buy it. I might have sold that within 5 minutes. I might have sold it within a day, 2 days, a week. It might become a long-term play. I might read about it, do a bit more research, and think, actually, there's something to this. This is worth keeping. So I try to trade a bit and probably lose money trading, because no, I don't lose it, but some I win, some I lose. But I lose too many on trades because it's boredom. You sit there and you're watching your stocks day in and day out. They're the same stocks that you believe in, but you get a bit bored and you want to do something. You go and do a trade, and half the time it's a boredom trade and you lose money on it. Other ones are good. So trade a bit, but I've got a core investment that I hang on to.
And what sort of return do you reckon to achieve each year?
Well, in the 20 years I've been doing it, I've done over 30% per annum. Some years I've had a lot better than 30% per annum. Some years I've not maintained 30%, but it's over 30%. I think Castleford Tiger, I think he was saying about 30% as well. And I know when I watched Andy Bruff, he was saying they do 15%, but he seemed to think that if you was a private investor, you ought to be able to double that. So 30% seems to be a pretty acceptable average if you're doing this day in and out as for a living, and you're watching the stocks and you're watching shares day in and day out. I think 30% is probably a decent target. Some people might not want that. They might just want a regular income, but I'm probably more aggressive and like the sex, drugs, rock and roll side of shares and stuff that's going to make me, when you get to my age, you've got to make money a bit quick. It's no good hanging around. Don't be fooled by these boyish good looks. I'm in my 60s now, so it's
you look very good for that. You really do.
Thank God for that. Yeah.
So what alerts you to a new investment? You talk about the RNSs that come out on the day, but are you looking for quantitative factors? Are you looking for qualitative? Do you screen? Do you look at charts? What's the key criteria which makes you look at a new investment?
Well, anything. It can be anything. I'll read the RNSs every morning and go through those, and it might be something in there that I see and I think, oh, that's interesting, and that gives me a chance to go through a lot of the older RNSs, maybe have a look at the annual report and do the eye test on the directors. I show the photograph to the wife, and if they got shifty eyes, do you trust these men? And then if that passes that, then I'll read through a bit more and see whether I think it's a good investment or not. So that might maybe one thing. Another thing, I might see a chart, and the particular movement in the chart might trigger my interest. Sometimes I'll read an article. Someone may mention something on a bulletin board, or someone on my chat room says something and says, what do you think of this? So there's various things that trigger my interest, but usually I've got a criteria. It's the chart, the directors. Let's talk about recovery plays. If it's a recovery play, I want to see a company that's had a new board. So bad directors rarely become good directors. So when a company's been bad for a long while, it's no good sitting there and thinking that board's going to change. The company's going to change. If they haven't managed to do the right thing in 10 years, they're probably not going to do it in the next 2 years either. So I'm looking for boards that have been kicked out and a new board's gone in there. Then I'll probably look and see what the directors are like. What's their history? Have they got a bit of decent history about them? Next thing I want to see is the chart starting to change. A lot of people know that bowls are the thing that I like about charts. Now, a chart to me zigzags down. Well, you're watching it up and down as traders are selling on highs, buying on lows, and it goes all the way down. But I'm looking for a recovery play where that's been doing that, and then suddenly the chart changes. You see like the zigzag stop a little bit, and it starts to curve and make a bit of an apex. If I can see that in a chart, it usually tells me that something's changed. The people that are buying for a reason now instead of for a trade. They've probably, a bit of news gets into the market. Directors speak to somebody. Someone tells somebody this. Directors talk to brokers, and brokers feed people into it. And the chart starts to change. And if you can get a curve on the bottom of the chart, I don't know what it is, but that is a powerful signal, along with a change in the board. So those two issues are the first two. The third one is a statement from the company saying things are not getting any worse. When you get the company, when they actually tell you that things are, SHI today, for instance, that's one of the stocks that I'm holding. It's a stock that's had a refunding. They've got new board in there. The directors have been buying shares. Today they had their trading update, and they're a little bit better than what they'd led the investors to believe. They're saying they're trading a little bit ahead. Well, that's what I would expect after Francis has been in there 6 months. So that's what you'd expect after like 6 months. You'd like to hear they're not being negative anymore. They're just starting to sound positive. That's the best you can hope for after 6 months. It takes about 9 months to 15 months for a new board to show tangible changes in a company. So but the share price will start to move before that, because investors, invest in the future. They're not investing in the past. So they're looking six or 9 months ahead. So the share chart starts to turn before you actually get that sort of news, usually from the directors, which is a good signal. So they're the 3 signals, and the 4th one is director buying. Yeah, I want to see directors buying shares really, which tells me that they're putting skin in the game. Their money where their mouth is, and they're doing what they say they're going to do. So those 4 signals, that's a new board, the chart's starting to turn, a less than negative statement, and directors buying. And if I can see those 4 symbols, I can pretty much say to you that stock is probably, in all likelihood, going to turn around soon, and it's going to be in an uptrend. Doesn't always work. Nothing's 100%. If it was, you'd just buy every one of those and just sit back in the Bahamas and wait for the money to roll in. So some don't work, but I'd say 75 to 80% of them come good. And that's what I've tried to do in recent years. Look for bowls on charts in any stock. It doesn't have to be a recovery play. That sort of trend, that bowl on a chart, tells you a lot. Something's usually changing. Again, not always, but most of the time, something is changing in that company, and it's worth paying attention to when you see that signal. In a recovery play, that is really, really hasn't actually got to be a bowl. You want to see the start, even if it comes to a sharp end and then it starts to curve up. That's a good signal as well. But that curve is and try to buy the apex right at the bottom. Don't buy it while it's still going down. Bang in the bottom and catch the bounce. So that's what I try to do with recovery plays, really. And they'll be fed to me from anywhere. I'll pick it up from RNS statement or a chart or.
And these days, you pretty much just go for recovery plays. You're not going for other qualitative or quantitative factors.
Well, a year ago, I couldn't see any value in the market. It was just there was nothing to buy. So I was buying just bowls and charts in the FTSE 250 and trading and making a bit of money through the FTSE. It was so demoralising that I looked through a lot of small caps and there was no value about at all. Because then we had COVID and share prices just plummeted, and it's put so much value into the market that I look around now and I'm like a child in a sweet shop. I can see so many. I've got a list of stocks that I could, say that look like they're going to come round good, provided the market stays good. And that's, there's so much value there now that recovery plays are here, there, and everywhere.
We've got some of those bold charts and some of the companies you've been looking at. Should we run through a few of those now?
Yeah. Let me just say as well that. None of these are tips, and I'm not telling anybody to go and buy these. I just say to you, this is my opinion. This is what I'm doing. Do your own research. Whatever you do, go out, read the RNS statements, go and have a look at what the company's actually doing. Have a look at the company annual report, do a bit of digging, and, these aren't tips. They're just what I'm doing. And if you think, they lead you to think they're a good stock, then have a look yourself and make sure you do your own research, because you're the person pressing the button to buy. It's not me doing it. So I'll just give you my opinion.
So I think the first one we've got to come up is Xaar. Do you want to talk a little bit about Xaar?
Xaar's good. That's probably one of my favourites at the moment. And the reason I like Xaar is they've got a new board in there, and the new board are all from Domino's, not the pizzas. It's the printer company that they're from, Domino's Printing. And these guys, I had Xaar back in 2015, and Xaar and Domino were two they're inkjet printing companies. And at the time, I had to debate whether to buy Xaar or Domino, and I bought Xaar. And then one morning I came down and Domino's had been bought out by a brother for 30% premium on top of what the share price was for cash. And I thought, and Domino, after I read about it, had been run so much better than Xaar had been run. Xaar was the popular stock. Everybody, all the tip sheets were telling you Xaar this, Xaar that. Everybody spoke about Xaar. And I probably got sucked in with the Me Too factor and bought Xaar myself. It's been badly run for the last 7-8 years. The boards just don't seem to know what they've been doing. Anyway, cut a long story short, Domino's, the guys from there have come to Xaar and now they're running it. they've changed the model. The company's been selling to end users. They're now going to sell to original equipment manufacturers, which means they should have far higher sales. I presume they're probably going to be a bit less than if they're selling to end users, because if you're selling more, you're probably going to give people a discount. But their sales should increase really well. And these are guys that know what they're doing. The share price is currently, I think it's a upper 8 is 86, 88 pence, somewhere around there. The market cap of those is somewhere in the region of about 68, 70 million. They've got no debt. They've got 24 million in cash. And that leaves, if you strip the cash out, they're trading on one-time sales. That sounds ever so cheap to me for a tech stock that's, going to be in high demand going forward. They've been printing tiles for bathrooms and stuff like that for the past few years, but there's so many applications where inkjet printing is going to be used in the future. They've got a 3D printing business, and the previous board decided that they were going to sell this out to a company called Stratasay. Well, they've given Xaar $15 million already, and they've agreed, and they've taken 45%, and they've agreed to buy the other 55% off of Xaar in the future, possibly. It's not a done deal, but if they want the rest of the business, they've agreed to buy the other 55% for $30 million plus. So that's like another 26 million that would come into Xaar. And so they've only got 24 million. If they get that 26 million, I know it's down the road, but there's potential there for them to have almost as much cash as the market cap. Plus, the company is actually turning around. The last statement said that they've done as good as they expected, and they've not been hit by this. The directors went and bought shares right at the bottom. The shares have come, they are around about 12, 15p. The shares have come up to 86 pence now, but at 86 pence, there's only 70 million shares around. They've never had any dilution other than a couple of percent. So the £11 a share they were at one point back in 2014 has seen no dilution. So if they get back to anything like looking what they were doing before, they're probably going to get back to that sort of price with a bit of luck. And I would say on the chart, you can see the bowl from sort of like July 18. The shares have gradually gone down, but over the past sort of July 19 to now, they've come from £1 down to 12p and then back up to near £1 again. And if you was to compress the chart more, you'd see it more graphically. The chart's spread across the screen. So if anybody compresses the chart, you'll see the curve that's there. This one's almost a perfect bowl when you compress it down. So that's one that I like. They've got their results on the 30th of this month, so next week. And I'll be looking forward to reading them and seeing what they say. But I think it's one. Also, Andy Bruff, who I think is a very good investor, has just bought about 28% of the company as well. So through Schroders, which is a good indicator. I think there's something about Andy Bruff. He must look at stocks the same way as I do, because we seem to cross paths a lot of times. Whenever I'm looking for shares, he's bought several. I go in there and I sort of think, oh, he's bought that. That's a good sign. Or I'll have bought it and then I see him buy afterwards, and I think, oh, that's good confirmation. So, nice guy, and I think he's one of the investors that is worth following, really. So that gives me a bit more confidence. If he's buying more, then I'm more confident in my own pick on that one.
Superb. And what do you want to move on to next?
Go on, let's go to DLAR. Should we do DLAR?
Perfect. So there's the chart for DLAR.
DLAR, they print pound notes, and I hope that I'm going to be doing the same when their shares go up. They had a problem in they lost their passport work with the UK government, and it's gone out to France. And so that sort of like devastated them quite a bit. And everybody sort of says, currency, people don't use pound notes anymore. That's wrong. It's a misinterpretation. A lot of currency is turning from ordinary paper notes to polymer notes. And these polymer notes are far better because you can put greater security into them with holograms. You can have holographic bands that run right the way through the note. So the security within the note and the ability to avoid fraud for countries is far superior. And that's one leg. That the currency they're doing. They're not doing passport printing anymore, but they also do authentication, and they make tax stamps for things like cigarettes, where you have to make sure that the cigarettes aren't fraud. One of these holograms goes onto the packet. It's secure. It stops people buying fake cigarettes that are full of like rat poison or whatever's in these fake cigarettes. It brings the country in the revenue they are due through tax. And so there's big demand for the authentication, not only just for governments, but for companies. Like you see the holograms on the side of boxes of software and various bits and pieces on a CD, on all sorts of things. So there's big demand for that. And De La Rue said their sales were actually up 60% on authentication in their recent statement. They also said that currency is at its full printing capacity for the coming year at 100%. That changed on their last statement. The previous statement said 80%. So they've gone from 80% to 100% on their currency demand for the year, and they're up to printing capacity on that. They're getting rid of a lot of staff up in Gateshead, which is sad for the guys that work there. But the one thing about what's happened with COVID is it's a lot of companies have had the chance to actually cut costs in a way that they couldn't do it in the past few years. It's ever so difficult for a company to say, we're doing well, profits are up 20%, great time, we're giving the directors loads of bonuses. Oh, by the way, guys, we've decided to lose 200 jobs. They just can't do it in the good times. When things like this happen, they've got an excuse for getting rid of those jobs that they should have done in the past, but they've hung on to, and cut the costs that they need to do, get rid of head offices and stuff like that. So loads of companies at the moment are cutting costs, and if we get a bounce back in the economy, their margins are going to be far higher. So for De La Rue, I think their margins are going to be greater. They've cut costs well, and the real good thing is they've got a new board in there. They've got a guy called Clive Vertu, who's a turnaround expert. They've had a fundraising for 100 million. They've got literally no debt now, so they're pretty much debt free. They've had trading statements which have been fabulous over the last couple of to say saying how well they were doing as far as the currency goes and the authentication. The licensing side is going to be defunct. And when you look back at where the chart was, let me just have a look on here and their dilution. I think they've got did make a note of how much their shares have been diluted by in the past. I think it's about twice as many shares as there were when they were at £11. So if they get back to their previous high, that's £5, £5.60. People still want currency. I just think it's a fantastic turnaround opportunity. You've got a new board. The chart's doing the right thing. You can see down in this bottom part, you've got that curve from July last year to now where it's sort of done a flat bottom, bounced up. That was the fundraising with the big bounce up, and the chart started to make that sort of classic. It's not smooth. You'd like to see it smoother than that, but the real reason for that is there was the drop for COVID, and then there's the flat piece, and there was the bounce up for the fundraising. And otherwise, that would probably have been a smooth sort of like curve at the bottom of there. They've got their trading statement. I think they've got their results in November, or the next trading statement's in November. That's the next update sometime in November. I've not got a date for that yet. But that's one that I think is going to be rather good coming along in the future. So that's another one I hold. If punters like it, then have a look. I should just say, I think they're 42p EPS last year. So 21p with the dilution. That's probably 21 pence EPS this year, maybe, and 23p possibly if they get a bit of growth. I don't know. So you at £1, well, they're £1.30 today. They're probably running on a P of 6 or 7. That doesn't sound desperately expensive to me for a company that's got no debt and seems to be in a turnaround situation, but we'll see.
And what would you like to move on to next?
Well, I spoke about SHI earlier on. Is it possible to do that one at all? This is another one. They've got a new board in there. SHI is a company that's the shareholders in there have been so abused for so long by so many different boards. The no board seems to have had a clue, and the last board seems to have got rid of all their best people. They seem to have had no regard for having any sort of skill at all. They've just wanted to sell at the cheapest price, giving no value for money. And recently they've had a new CEO whose name is Steve Francis, who became permanent CEO in April. SHI is the ticker. The company's called SIG, and these do roof insulation, roof tiles, plasterboard, building materials of many sorts. The thing is, for years they've been run badly, and the whole point of a building merchant is that you've got to be able to advise your builders what they actually need, rather than, as we've seen with Grenfell is a classic example. People weren't advised properly as to what sort of plastic should have gone on the outside of the building, and of course Grenfell Tower burnt as it did, and the wrong insulation was on there. Builders rely, and other people rely on people like SIG to be able to give them good advice. Steve Francis has gone in there and he's got back a big number of the guys that are heading this company that knew everything about the product, where the old board just got rid of them, which was say no more. So he's got the old guys back. They're going to the companies that supply them and asking for greater rebates for greater sales, basically, and this should increase margins over time. SHI was, what was the price that they were up at? They were £11 back in 10 years ago. They've been diluted quite a lot, but to get back to where they were, they could probably go to somewhere. Let me just have a look on my notes for dilution. In 2014, somewhere in the region of about £1.80, £2 if they get back to where their original original amount of shares were in the market. So there's plenty of scope for them, but it's early days. I think I've probably bought into these a little bit early for the recovery. Like I said, recoveries take 9 to 15 months, and on the refunding that they did, they had a placing in which CDNR took 27% of the company recently, back a few months ago. And they also had another placing, an open offer where shareholders took shares as well, and that was done at 25 and 30p. So the shares took off from about 20 pence up to 40 pence. I think where everyone got excited, and it probably was a little bit early. You need to see tangible results. Well, I've listened to the statement today from the company, and Steve Francis sounds like a guy who's got a plan. He sounds very credible. And it's worth re-listening to that statement again today that they put out, because I think this company is going to come good in the end. It may be a waiting job where you've got to wait another 3 to 6 months before you have a trading statement and you start to hear the sort of sounds you want to hear from the company. But the share price will probably react before that. So that's a nice company that I think will probably do well, but it may just be a little bit early at the moment. I don't know. I'm going to hold and see how it goes. I think it's got the ability to go a lot higher, really.
But timing is everything. And how do you think you could have got your timing better on it?
I don't know, because at 25p the shares were racing away, and I was buying, thinking that this is probably the turn here. This is the catalyst that has made the shares rise. They've got to 40p and they've pulled back. You pay your money, you take your choice, and this is one I've paid my money, and I may have to wait for this one to come good. On a fundraising, you just don't know how the market's going to take it. They're obviously excited to start with. This CDNR that have taken 27% obviously see something very good at 25p for them by 27% of the company, and I think that's a fairly good guide. Unless they're completely crazy, I don't know. But timing is never perfect. Sometimes you buy things and you haven't timed it quite right. Sometimes they actually let you down on these things. That's why this has got the formula. It's got the share price turning. It's got the director buying. It's had the fundraising, which is good. It's got the new board in there, and the guy's saying all the right things. But it's like I think Steve Francis said today, it's a 6 to 9 month thing before you're going to start seeing any real tangible changes. So, either if you're in it, I would still be holding. Maybe, I don't know. That's what I'm going to do. Other people may want to buy while it's low. Some people might want to ignore it. I don't know. But this is one that I think is very worth keeping your eye on.
And for your core positions, how long do you hold them?
Could be anything. If I've got a long-term hold, it may be anything from 9 months to 3-4 years. The thing is, I think the last one I held a long time was Future PLC. I bought that at £1 and I sold it at £12 about 2 or 3 years later, probably about 6 or 9 months ago. It's carried on doing quite well, but really I'm looking to, once a share gets to £12, what's it got to do to double again? It's got to go to £24 when it's come from £1. And I'm there thinking, in this market, there's a lot of places where I can more safely find something that's going to double from a low base than I am likely to find Future PLC doubling from a high base. So while I still like Future PLC, I think it's a great company at the moment. It's doing ever so well. I took my money from there and I've been buying stuff that's lower down that I think that can double sooner. So I've not got no set plan to hold things forever. It's just until the valuation says, what you can find cheaper elsewhere that's going to grow faster.
So your catalyst for selling is generally based on the valuation?
It'd be the valuation that's what's around it as well. As long as if I can find stocks that are cheaper elsewhere that look like they're as reliable to get an income from, then I'll go across to a different stock. So I never get wedded to a stock. I've been there before where people sort of like fall in love with a stock, and you start to love the company and you start to believe in it, and you're believing in the company more than you should be. It's got to be cold-hearted, and just this is a casual affair. It's not a marriage. So.
And how many holdings do you normally have at any one time? And how large percentage of the portfolio would they get to?
I don't say never. I rarely go over 10% of my portfolio in any one holding. Risk reward is important. You're trying to eliminate risk and you're trying to maximize reward. If you start taking positions which are over 10%, you've got to do something else where you're probably all right as long as you've got a dozen holdings or so, and you might have one that's up. You've got to make disasters happen. I've had companies that out of the blue have just suddenly said, well, you know what, we've got a problem. Luckily, I wasn't holding Patisserie Valerie, but something like that happens. RBG, the Revolution Bars. I can think of that one. I can't think of the name of. There was one when I was investing a long while ago. The chairman bought £250,000 worth of shares one day, and everyone thought, that's great, follow him. And about 3 days later, the company was suspended. It was like a home serve type thing, home buy. I think that was it was home buy, I think, which was the company when it was floated, or under a different name. And who would have thought the chairman buys £250,000 worth of shares, and a few days later the shares are suspended, and he didn't have a clue what was going on, or maybe he did. I don't know. So those type of things happen. So when I hear people say they've got 30% or 40% of their holdings in one stock, I just think, oh no, just don't do it. It's all about risk versus reward.
And how many holdings? Say 10 or 15?
I've currently probably got 22. It's too many. I should only have about a dozen. Everything I've read and everything I feel is a dozen's about right. You maximize your risk aversion that way. You're not getting you're keeping your risk low, but you're also not diluting your shares so that one good one comes along. If you've got one good one, it's not weighed down by 19 bad ones or mediocre ones. So it's a matter of trying to get the best ones up to a decent size, but not going out too far overboard.
We're going to run out of time, but let's just cover one more company that you are particularly in favour of at the moment.
Let's have a little look. What about VTU? okay, this is a car dealer. They own Bristol Street Motors, Farnell, Macklin, and Vertu. They acquire companies as well, so they're quite acquisitive. But they're currently on a PE of 5.2, which is falling to 4.7. They've got debt of about 100 million. Might be a little bit over 120 million, but that doesn't worry me. What I actually think is people are going to buy cars. Yeah, car dealers have had a bad time, but eventually you've got to buy cars again. I have people saying to me, I'm not going on a train, I'm not using public transport. Well, how are they going to get about? They must have to buy cars. So I think car dealers are pretty much oversold at this point. Electric cars are coming in, and mate mine's just bought an electric car, a little hatchback thing for £40,000. And I'm sat there thinking, a year or two ago, I wouldn't have thought anybody was going to take up these electric cars. They just didn't look like they were the real deal. But for running about in town, people are happy to buy them. People have got this environmental thing going on, and they don't want to burn carbon fuels. And so I'm thinking, this really does look cheap on a PE that low. The CEO Robert Forrest has just bought 250,000 shares. There's a guy, Richard Teetum, who's a car dealer up north and an entrepreneur, and he's bought 3% of the company just recently as well. And they just look cheap. I just think they're going to they're due a trading update not too long, or some results are not far away, probably within the next month or so. And I just think that's a good little place to be on a PE like that. The whole sector looks like it could possibly be oversold at this point, and they look like the best of the sector. So,
and the chart?
A quick one for you. The chart, there's no real bowl other than the very last little bit at the end there on the chart. There's nothing special about that bowl other than to say, if we hadn't had that COVID dip, the chart would have probably gone down and made that little curve there and over the very last few months. So there's a bit of but it's tenuous. So I wouldn't say there's no board change or anything. This isn't one of those recovery plays. This is just one of those cheap plays where the earnings growth seems to be outweighing the PE by quite some way. And it's more, it's not a Zulu stock, but it's almost in the Zulu sort of like frame of Jim Slater to me.
Great. We've got far more we can talk about, but I'm sure there are loads of questions. So I think we better move on to questions. Bhaskar Patel has asked, you talk about liking recovery plays in recent times. What do you think about Greggs today and house contractors?
Well, Greggs, I'd leave it alone. The chart tells you to leave it alone. Why buy a chart that's going down like that? I like Greggs, great company. Offices are not going back to work. People are staying at home from working, and Greggs relies on that office trade. And until that comes back, I think Greggs are going to have a little bit of a problem. There'll be a time to buy them, but I wouldn't buy them just yet. As for house builders, the charts still say don't buy. The charts are going down, so don't buy. Don't catch a falling knife. Wait till you see all the builders' charts starting to make a bit of a, for argument's sake, a bit of a bowl or a bit of a turn at the bottom before buying them. I know they're telling you that things are great and they're doing quite well, but I'm sure they're being held up by shortage of supply or certain other things are holding up. But there's something that the market doesn't like about house builders as much as they do building supplies. I think sort of things like one I'm holding at the moment is Tops Tiles. I think their recent statement was good. And I think also there's Kingfisher, which are doing quite well. I think possibly Marshalls will probably do quite well over the next 6 months as more supply seems to come online. But the demand for their products is high, whereas house builders, for some reason, they don't seem to be getting the houses. They might be selling them, but I don't know what the reason is for their charts not to be turning up. I've seen direct buying going on in there, but the chart isn't turning up. So until I see house builder charts turning up, I wouldn't bother buying house builders, to be honest.
Great, thank you. And Andrew Kelly and Bob Meadows have a similar question. Andrew asked, did your style evolve through trial and error? And Bob says, great chat. What have been your biggest 2 howlers and what were the lessons?
Loads of howlers and loads of mistakes. If you don't make mistakes in this life, you're not doing anything. Anyone who doesn't make a mistake is not taking, isn't doing anything. They're sat at home just having a cake or something. So I would say, yeah, make plenty of mistakes, but learn from them. I've learned from loads of mistakes. Biggest howlers, oh God, I'm trying to think. Well, the biggest howler would have been that home buy one, which I was mentioning just now, where the chairman bought shares and I bought, and the next day, bang, they were gone. They're still sat in my Killick account. The name's still sat there showing me on my Killick account. And I'm reminded every time about that one, and I'm quite glad it's there because it stops me doing some silly things at times. So that was a howler. I'm trying to think of another howler. There's been plenty. It's trying to think of them all. Think of them up to date. I can't. I suppose when you're an optimist, you tend to focus on your successes and forget your failures a lot. But I'm sure there's been plenty. I know there is. It's just trying to call them to mind at the moment.
And we'll go to Matthew Appleyard. Matthew, do you want to unmute yourself and ask your question?
I just wondered, do you have a view on the insurers, particularly like Legal & General? The chart's very much a falling knife, but it seems to be very cheap on some measures.
I've never really invested in insurers. I've stayed away from them. They usually run on a low PE. There's always things that sort of crop up with insurers when I've had them, like some natural disaster happens that no one had expected. Insurers get hit, and you wake up in the morning and suddenly you think, "Oh, what's happened?" And your insurers have gone down. I really can't answer that question because I never really got involved in insurers, and I find them difficult to value, to be honest. Sorry that's so short, but it's not one that I try to stick to retailers or things that I understand really well if I can.
And we'll move on to a question from Mark Atkinson, who says, as your investing style has changed over the years, do you think that your present strategy is the end result, or do you think it could continue to evolve?
I'm sure you probably do. Your strategy does evolve all the time, really. I think if you're not evolving, you're not. You get things like flash trading at the moment, which never used to exist. And I used to look at order books on level 2 and think I understood them. Well, I don't now. I don't know what goes on in these order books. It's like some game of okey cokey between the market makers and some big fund somewhere, and all these little trades of 5 shares and stuff like that never used to go on. And so I don't pay a lot of attention to order books now, which I would have done 5 years ago, and I'm probably sure in a few years' time I'm going to be not paying attention to some of the things that I pay attention to today. And things will change. The high street's disappearing. I used to love retail stocks because you can go in there and you can have a mooch around at WH Smith's and see what was going on in there and various places. That's becoming more difficult if people go online. So now you've got to try and find retailers that are online because that's where the margins are. And it's the online retailers that are really the company to be. But quite recently, I've changed my sort of like buying target to companies that are internet orientated rather than high street, and mainly new world stuff like companies that are connected with internet infrastructure and stuff like that, where that's where the money's going to be used, working from home, doing computing and stuff like that, or anything at the current time that is getting a boost from the COVID thing that we've got, and getting rid of the stuff that are heavily affected, like airlines. There was a time when I loved airlines, but airlines at the moment just aren't going to have a great time, nor are restaurants. Retailers are going to find it tough. So I'm moving away from some of the things that I would have bought in the past, and I'm buying stuff that I didn't used to get involved with so much as much as online and internet stocks.
We'll go to Barry Singleton. When do you decide you've made a mistake and therefore sell? Do you have price limits, or is there any other indicator?
I usually decide I've made a mistake about 5 minutes after I've bought something as a trade, actually. It's sort of like I'll sit there and I'll buy something and I think, what did I buy recently? Serco. Yeah, I looked at the results on that morning. I thought, these are really good. This is fabulous. And I bought it as a trade. And I sat there and within minutes it was diving like mad. And as it happens, I didn't sell that one. I hung on to it. I should have sold it, but it's usually at a point when I get scared is when I trade it, or when I decide that I've clearly made a mistake and I'd be better off sort of using that money somewhere else. I'm never afraid to sell a stock. Sell it as soon as you think you've made a mistake. Sell it. Find somewhere better to make the loss up, and that's what I would tend to do if I made a mistake. Just it's an occupational hazard. Just sell it and find something better where you can make the money up at a faster rate.
And follow on from that, do you ever use stop losses?
I used to use stop losses a lot, but again, it's getting more and more difficult because in this market, I'm invested more in small caps because that's where the value seems to be. And trying to use stop losses on small caps is very difficult. So I've virtually stopped using stop losses now because what you tend to find is the market makers move the share down to a level where they think the stop losses will be taken out, take your stop loss out, and then move the share back up. And it defeats the object of having a stop loss, really. If every stop loss is going to get hit and then move back up, or you've got to put your stop loss that low that it's meaningless anyway. So I'm finding stop losses are a lot less useful these days.
And we've got multiple questions from Peter Martin and Xaar and a few others on your view on loop up.
Loop up, yeah, very good. I think they had a statement out yesterday, which was well, fantastic, really. And I think home, as I just mentioned, people working from home is a place where there's lots of money to be made for companies that do supply that sort of thing in recent days, and people are going to be working home for another 6 months yet. So I would imagine that's a sector where the shares are going to do well, and people are underestimating the amount that we're going to be working from home, and we're not going to be using stuff like HS2.
And John Thorpe asks, Ted Baker seems to have the qualities that you look for in a recovery play. Do you have any opinion?
Yeah, I like Ted. I think that's another one which, if we'd had time to run through a lot of stocks, I might have mentioned. Ted Baker's got a new board in there. They've been buying shares. The chart's made a bowl, so it's got all the things there which you like to see. I'm trying to think. The shares I think are about £1.3 now. They've been weak in the past few days. There was a government data thing that came out that said retail sales were down for clothing companies, and so I think probably them and M Brown, which is another one that I like, BWNG, they both took a little bit of a hit back, but both those companies have got direct to buying. The charts are making a bottom, and they're M Brown's 90% of the internet and 90% of trades on the internet, and Ted Baker's moving more and more towards the internet. So these companies that are getting over towards the internet, then I think that's it. Like that's M Brown that we're talking about there, which you can see at the bottom there. I think I bought it about 25p, and they've sort of doubled in the past month or so. Couple of months, and Ted Baker bottomed out at about 75 pence on a placing, and now it's still up at £1. So it's had a good run. It did get to about £1.20. It's had a bit of a pullback, but I think that's just down to the data that came out on clothing retail sales. But the internet companies that are doing sales online, I think, are doing far better than what the high street retailers are doing. You've got to have a massive internet presence now if you're a clothing retailer, and those are the ones that are going to benefit, I think.
And we've had numerous questions asking to know more about Richard's chat room. Could you give a bit of an overview and tell us how people join it?
The chat room is 270 people. It's a limited, just 270 people. We're all sort of like nice, good guys and girls out there. We're all looking after each other's back rather than being on the internet chat rooms, where I find very unpleasant places and lots of trolls and stuff like that. So I've tried to avoid that. So it's pretty much full, really. There's only about 10 places left on there. If people are interested, they need to just contact me on rebel at cockneyrebel.uk, or contact me on Twitter, where I post, which is at rebelhq. Twitter's the only other place where I post. I do post there quite frequently. That's great for posting quick one line or two line highlights, and I know you get the ramping accusations there, but that's all Twitter's good. You can't have a discussion on there, and there's a lot of guys that follow me, and quite often I pick up a highlight from somebody on there, that a highlight of stock, and that's very handy, and I feed the same back. I might see something and give a few people a heads up on there. So Twitter basically just for heads up, but I do most of my talking in my chat room, and if people are interested, then they can contact me there. But like I say, there's probably only about 10 spaces. It's pretty full, really, and it's just us 270 guys and girls having a good time, all making money together. It's pretty boring making money on your own. It's nice to be in a group and everybody making money together. It's a boring, life's not just about making money. It's about having fun with other people.
Brilliant. Thank you very much. I'm afraid that's all we've got time for. I think we'll have to get you back again because we've got lots of other companies that we could have talked about. We've run out of time.
Yeah, that's an hour of my life that's flown past far quicker than I expected.
Thank you so much for a fantastic webinar. If you want an email notification of webinars or events that PIWorld are organising, go to the right-hand side of the homepage at piworld.co.uk. There are two boxes. The top, sign up for a notification of a new video as it's published, and underneath, sign up for events. Different lists, no spam. And please do tell your investing friends about PIWorld and write comments or like our videos on Twitter, bulletin boards and YouTube. We also produce all our videos as a podcast, so do write reviews for any of the podcasts on iTunes. We'd like to go on providing these free webinars, and getting really good speakers like Richard relies on you and the audience numbers we attract. And if you have ideas for speakers, which is how Richard came to us, do email or message me. You can find me through the contact page at piworld.co.uk or follow me on Twitter at TamsinPIWorld. Many thanks to you all for joining, and stay well.